Behind the Ticker is brought to you by UX Wealth Partners. If you're a TAMP user and you're sick and tired of the legacy technology they are run on and you want more customization and flexibility, as well as a AI-driven model marketplace, UX Wealth Partners is your destination. On top of that, they have institutional trading. So if you are an ETF issuer or an SMA provider looking for outsourced institutional trading, UX Wealth can also be your destination. So check out uxwp.com to find out all the ways UX Wealth Partners can help grow and make your practice more efficient. Welcome to Behind the Ticker. Today we have on Mike Loukas. He is the founder and CEO of TrueShares, and they have a extensive lineup of active ETFs. But today we're talking about their newest issues, QBUL and QBER, which is QBUL and QBER. They are a quarterly resetting hedged equity product. I'll let him explain to you how they operate and how they work. I think they're very interesting products. I think they could be used for active portfolio managers as they are maybe in a risk-off mode to allow them some upside exposure. So without further ado, please welcome Mr. Mike Loukas. Hey, Mike, welcome to the show.
Yeah, thanks, Brad. Good to be here.
So why don't you start by, telling everybody a bit about your background and how you ended up at TrueMark Investments and then ultimately starting TrueShares.
Well, we started TrueMark Investments for the purpose of starting TrueShares, right? So that's one and the same to me. But we founded TrueMark back in 2019. And, after 30 years in the business and lots of time fighting the tide, I realized that, maybe ETFs are really going to stick around. And more so than that, I think we saw the next leg up for not just actively managed ETFs, but really get into that sort of solutions-based platform for ETFs where, the evolution was sort of passive index strategies and then thematic. And now I think it's morphed into, let's take more traditional active strategies. Let's take some more institutional hedging strategies. Let's take portfolio construction to a whole new level. And that's where we wanted to be. So that was the onset of TrueShares. And we launched our first ETF products in 2020. We snuck them out literally right before they put a moratorium on listings for COVID and the shutdown and all that good stuff. And then we haven't looked back. So I think we're 21 names, 21 tickers out there right now across all three exchanges, and a couple more in the pipeline. And we'll keep moving on with ideas that we think have merit out there and continue to build what we think is a pretty good brand name for TrueShares.
No, that's great. And before we get into kind of like the nitty gritty of TrueShares, the type of products that you offer, and we're going to talk about two of your ETFs today specifically, what do you like to do for fun? Any hobbies? You and I were talking about donuts before we started, but I'm sure that's not a pure hobby of yours.
Yeah, it used to be. No, the donut thing has gone by the wayside, but, look, I'm a traveler, which fits well with my job, right? So I think not unlike a lot of folks in the last few years, I've fallen in love with Japan, with the exchange rate where it is. If you haven't gone there yet, do it and do it now. Just an amazing place to be. I've gone there a few times in the past couple of years. Like to travel to other places in Europe as well. I mean, I'm over 50 now, so I think that automatically qualifies me to dig into military history. So that's a bit of a hobby of mine. But beyond that, sort of golfing, skiing, like to stay in shape and keep active. I think that's sort of the key, right? Keep moving and try not to sit for too long.
Yeah, no, I would, you and I share golfing, skiing, and traveling. It's ski season here in Pittsburgh, and I haven't picked up a club, and I'm starting to get the itch. It's like you're ready to give it up for a month, but, it's negative like 2 real feel here today. So I'm ready to start. I'm ready to pick up a club again. But you talked a little bit about the philosophy of the firm in terms of the type of products that you want, and you've got, 20 plus ETFs that you have issued. So what are some of the different types of products you've already brought to market? What's that menu kind of look like?
Yeah. So in the early days, we had what our interpretation of traditional fundamental active management is. We launched a few of those. We have an AI and deep learning product that's been out there since 2020. Pretty concentrated, long only, 21 names in the portfolio. And then we started to expand from there, and we put out obviously our structured outcome products, or defined outcome, or buffered ETFs as they're commonly known. We launched our first of those back in 2020 as well. So we've got a dozen of those out there. We started to build out our income and yield suite. We've got some great income products in the platform, both domestic and international. And then we most recently launched QBUL and QBER, which are quarterly bull hedge and quarterly bear hedge. So we'll continue to travel those parallel tracks, one being what we consider portfolio solutions, meaning, look, you've got a holistic view of a portfolio, whether you're a model provider or an investor, and you need the tools to create that expected outcome and risk tolerance of that portfolio. So we'll continue to put those tools out there. And alongside that, we'll opportunistically launch what I consider, quote unquote, standalone investments, which would be a particular strategy, particular asset class that might be in demand in the marketplace or solves a pain point. So maybe a little bit more of the solutions based than the standalone basis moving forward. But those are our two dueling priorities in terms of product.
And some of the products, if you can correct me if I'm wrong, when I was looking at the website, you have sub-advisors on. So are people coming to you actively? And I would assume, given your product suite, you have control of your own trust. So are you, in the white labeler realm at this point, trying to compete with some of these white labelers out there, or do you have such a specific niche for these solutions-based products that you're kind of trying to be known more for that than, hey, we're going to launch anything?
Yeah, that's a great question. And in terms of the initial part of that question, the answer is a firm no. We are not in the white label space. Our intent was never to be in the white label space. I think the sub-advised product that we have really can come from two different areas. One, it can be someone coming to us, and it's a strategy that we think is timely, that can get up to critical mass quickly, right? Because we know in this business that daily volume or the ability to buy the ETF is as important as the ETF itself with the strategy underlying. So we look for those types of characteristics in what we launch with sub-advisors. We do a deep dive on the sub-advisor. If we partner up with one, we will more than likely do a follow-on product with them if that's something that is in their wheelhouse. But it comes from two different angles on that. One, it can be, look, we need a strategy that fills this niche. Who do we have in our Rolodex? Who do we know in the network that we can go out to and maybe find an asset class specific manager to fulfill? And the other would be them coming to us and say, look, we've got something we want to put up there. But by and large, I think it'll probably be about a 75-25 split moving forward, where the 75% will be internally managed portfolio solutions, and then we'll do opportunistic sub-advisory.
No, great. So let's get into the two ETFs we want to talk about today, which is your newest launches, QBUL and QBER, which QBUL is QBUL, QBER is QBER. So really at a high level, what are these two funds trying to accomplish?
Principal protection with directional market exposure, equity exposure. All right. So if you look at our structured outcome product lines, if you look at buffered ETFs in general, right, particularly the equity-based ones, the thought process behind them is, like, people still want exposure to directional market moves, right? They still want exposure to the growth characteristics of large cap equities, for example, but they want to mitigate the downside. And they're willing to give up some of that upside potential, right, for downside mitigation. And so those are great. We have a series of them. There are lots out there. They all do what they're supposed to do, as long as you understand the math behind them. And we thought to ourselves, look, they're great standalone. A lot of people don't necessarily understand how to implement them. And a lot of people implement them in a way that might be incorrect for their investment goals. And so we thought, look, let's target the holistic portfolio viewpoint again. And we can provide tools that can fully protect, or at least treasury risk, right, is your downside protection. in these strategies, but it can allow investors and model providers alike to get out there and incorporate these into their portfolio, blend them with whatever asset class they're in, just in case they're wrong or just in case they want to toggle their risk exposure, because it allows you to, create equity-based risk. However, you have upside exposure to large cap equities with QBUL, or potential downside alpha, right, with QBER. So they're mirror strategies, different directions. QBUL, 3 month, or 3 month duration before they reset. They reset every 3 months. So QBUL, it would be, look, if you've got a market move that's north of 5% in a quarter, then QBUL kicks in, and your downside is that of holding a treasury. So you've got this opportunity to say, like, I have this risk tolerance. It's non-negotiable. If the market booms in a quarter, which historically it does a heck of a lot more often than we think, I want to be able to participate in some of that, but I can't take on the risk. On the other direction, QBER, same concept. If the market drops more than 5% in a 3-month period, you will start to generate a positive return from QBER. In that band between +5 and -5 for the two strategies, you're flat, you're treasury. So it's really a more versatile tool, I think, than what we typically see out there. It's meant to allow someone constructing a portfolio to blend it with offered ETFs, blend it with long-only equity exposure, blend it with cash. So you can create all sorts of scenarios with most asset classes out there that can benefit from adding this ingredient to the portfolio to achieve what your desired outcome is.
Yeah, no, it makes a ton of sense to me. So just so we're, really clear, if I owned QBUL, I'm just going to get treasury return with maybe some income until the market exceeds 5%. Is that correct?
So if you're QBUL, market upside 5%, QBER will be market downside 5%.
And is it going to be a 1-for-1 after that threshold, or is it might never be exact?
Yeah, it would never be exact. So it would eventually start to catch up the farther the market moves in that direction. So if market's up 7% in a quarter, you're going to get, you'll get some convexity once it pushes through 5. So you'll initially start at sort of 1 or 2%, and it'll start to increase and gain convexity the higher it goes above 5. Same thing on QBER, in the sense that, if the market's down 10, you're probably going to capture, let's say 6% positive return, just obviously throwing out estimates. In QBUL, the same type of thing, right?
Yeah. I mean, I could see QBER just thinking about portfolio construction. I mean, if you're really bearish on the market, but you don't have the risk tolerance or want to short the market, you're right, you're going to get paid. You're wrong, you're just exposed to treasury risk.
Right. That's exactly right. Yeah.
Okay.
And it's same old concept with a hedge, right? No free lunch, right? So
Yep.
we can't give you the full benefit of the move, but we can give you an opportunity to, even if, say, you're tactical and your signals are telling you to go all cash, own some QBUL just in case.
Yep.
Right. You've got treasury risk, and you've got the potential to catch it, that upside if you're wrong or something occurs in the near term that changes the directional momentum of the market. And same thing with QBER.
Yeah, no, it makes a ton of sense to me. So can you kind of explain the asset allocation inside, kind of the balance in between, the treasuries that you're holding, and then I'm assuming you've got to be holding some options here. So how are these being constructed? Maybe start with QBUL first, and then we could flip to QBER. But how are these portfolios being allocated and then rebalanced every 3 months?
So much like we did with our structured outcome series, we try to keep it as simple as possible. When you have caps and 1-for-1 participation to a certain level, et cetera, you typically will have minimum sort of 4 to 7 different contracts in the underlying mechanism. With QBUL and QBER, very straightforward stuff. So the principal goes into a treasury. We take the anticipated yield of that treasury, and because it'll be a zero, right? So we take that anticipated yield, and then we allocate that to buying a directional position. So QBUL, for example, we will put the principal into treasuries, and we will take that income and we will go ahead and buy out of the money calls to the extent possible, right? So the higher the yield from that underlying income instrument, the more call coverage you get. QBER, same thing. You put the principal into a yielding investment, in this case treasuries, which is perfect where the yields are where they are right now, and you take that anticipated income and you'll buy a put position out of the money, in this case 5% below the mark. So the coverage on those will get you your convexity, right? So the more coverage, the greater convexity.
Right, and that's what I was going to ask. So does your 5% number fluctuate based on current yields of treasuries? Like, will that target? I know we use that blanketed, but are you always targeting that 5% gate, or is it going to be variant based off of where treasury yields are?
Yeah, it could vary, not significantly, but it could vary. So, if you've got solid coverage on your yield, you can get it down, say 4%. You're never going to have it down,
right,
2% or that sort of thing. But it can vary between sort of a 4% to 6% band.
Okay, no, it's interesting. And so, what was the impetus behind choosing a quarterly roll strategy? A lot of buffers are now point to point that are, year over year, or some now month to month. Like, what was the idea behind picking every 3 months?
Versatility, I think, first and foremost, right? So depending on how you're using these, and I think we could go on for a whole other podcast session on this, but I think the understanding of the sequence of returns, it was always misconstrued in the marketplace, where we're still so addicted to annualized returns and not fully understanding that the bulk of those returns come in short periods. So with the annualized product, or even the 6-month products, you have an extended period of time where your expected return doesn't necessarily match up with your current price or current value of the investment, because the options decay, because of the length of those options. So using a shorter time frame allows the product to react with a higher correlation to what the market's doing. And if you are, just as an example, one way to do this is, if you've got a 12-month buffered ETF strategy where you're layering or laddering 12-month buffered ETFs, and you blend it with QBUL, market pops, QBUL goes up, you can clip that coupon in dollar cost average it into your buffered strategy, right? You can trade out of that QBUL and go into QBER if the market has pops, reverse your outlook on it, clip that coupon, dollar cost average into the other asset class. So that correlation to the market is important to us, because we believe that you have to be versatile with some of these moves and take advantage of them if you're blending it with other asset classes. Now, there's always just, there's set it and forget it. So that the other aspect of that is it works for both sides, right? If you're not tactical at all and you like to set it and forget it, it just re-rolls every quarter. And so it's going to give you that dynamic sort of adjustment to the market on a quarterly basis, regardless of what you do. So you have that tactical option and the set it and forget it option, and that tighter correlation to market moves because of the shorter option expiration period.
Makes a ton of sense to me. I guess I asked this question on one hand, but I didn't ask it on the other hand, which was I asked you about yields and how that could affect your target, but I also missed, market volatility, right? And that's going to affect the price of the option. So can you explain that relationships as as markets enter a period of volatility? Let's just say, we get some volatility to rear here in the next couple of months, and how will that affect this product as you do your roll again in second quarter?
Yeah, so it's in the end, it will obviously have an effect, right? And I think that depending on the direction of that volatility, right? I always like to say there's good volatility and bad volatility. And so relative to the product that you're in, whether it be QBUL or QBER, if that's upside volatility, if it's the good stuff, yeah, sure, it's going to drive up price of calls. And, it will adjust to that, right? Based on how much of the underlying income we use to establish the call position. If it's that bad volatility, the downside volatility, it'll drive up puts. But again, understanding that these strategies will adapt to that environment because of their short-term nature. And that allows us that 3-month period, if that's extended volatility, it allows us to readjust to that volatility because we have a more opportunistic reset to the portfolio than having to sit around for 12 months and wait for it.
So let's talk about, you talked a little bit about how you would maybe utilize these products with, a series of buffered ladders and trying to create really like a defined outcome type portfolio. But if I'm an advisor, I've got your typical model portfolio, 60-40 that's holding low cost passive ETFs. How would you advise on them kind of incorporating these? Would you have them have one or the other in the portfolio at all time? If so, like how much? I know that that's going to be a total risk related question, and maybe that's a loaded and bad question. But how do you see kind of using them as a traditional advisor who'd be listening to the show?
Yeah, it comes down to conviction on market direction, right? So if you're purely establishing a risk tolerance and you've got a 60-40 or some other asset allocation that is meant to be an all-weather portfolio, you own both. You want a little bit in both because what you're doing is you're covering both tails. And if the market's up, it's going to magnify your right tail. The market's down, it would ideally, if the market's down as a dramatic move, you're going to create a positive return on the left tail, right? So adding it into your low risk sleeve, your treasury risk sleeve, is going to give you some convexity on both tails in a positive way. So if that's your goal, if it's listen, we like to build portfolios that are all weather. We have a expected return, expected risk tolerance, and we can blend this in without corrupting our risk tolerance and potentially add some convexity to the positive return of the portfolio, then that's great. If you have more conviction on the direction of the market, then that will dictate, say you started 50-50, QBUL and QBER, maybe 75-25, matching up with whatever your directional conviction is. So the beauty of having both in the portfolio, you can toggle back and forth to match up with your risk tolerance or your expected market return. And that's the reason behind both, right? Giving the ability to own both, toggle back and forth between the two, or own one standalone if your portfolio requires that based on your expected return and risk tolerance.
Yeah, I mean, for me, personally, this is a perfect product for the types of strategies that we run, right? And, when we get in a risk off mode, we're sitting in treasuries, right? And we are going, and there's a lot of managers that manage a long only active book like that, where you're moving into treasuries, or you're moving into money markets. To me, it makes a heck of a lot more sense to be rotating that exposure to QBUL if you're wrong, waiting for that momentum or those signals to change to start cutting that QBUL exposure and get long the other assets that you want to get long. I think some of the traditional buffers could theoretically work for that, but some of the caps can sometimes interfere. But this, I think, is a perfect product for any long-only active manager that tends to move into treasuries, money markets, or short duration when, they have a negative view on the market.
Yeah, I think you're spot on. And then when you talk about the buffer ETFs with the caps, for example, QBUL, mixing it in with those buffer ETFs, it can uncap the caps buffer, right?
Right.
And it's gonna have that effect of giving you some convexity to the upside. So you can fill some gaps, right, with existing product using these two, and But again, I think your understanding of it is pretty spot on.
Yeah. Well, Mike, I really appreciate you spending some time with me. I think they're really unique, and you've given me personally something to think about. But before I let you go, where can people learn more about TrueShares and your entire suite of products?
As always, true-shares.com is your best source of information. And you can reach us through that website if you want to contact anybody on our team. But it's chock full of information on all of our products. Best place to start. You and I know in the ETF business, 60 or 70% of your investors never talk to you anyway. So
Right.
we like to put as much information as we can at their fingertips. And once they get comfortable with what they want to discuss, then they can reach out to us as necessary. But that's the place to start, true-shares.com.
Well, again, Mike, thank you so much for spending some time with me. I appreciate being here.
Yeah, pleasure, Brad. Thank you.